Welcome to This Explainer. Today, we're mapping out what I like to call the living ecosystem of corporate accountability. Specifically, we're diving into Unit B territory, the nitty-gritty of an organization's external auditing procedures and who really does what. You know, when an organization gets audited, it's not just some solitary accountant sitting in a dark room crunching numbers. It's a highly structured interaction between different groups, each with very strict legal and professional responsibilities. Getting a grip on this ecosystem is absolutely essential if you want to understand how companies maintain trust, ensure transparency, and actually comply with international standards.
We're going to navigate this ecosystem in 5 quick chapters. The expectation gap, key roles and responsibilities, the role of audit committees, inside accounting systems, and finally, mastering internal controls. All right, let's jump right into Chapter 1, the expectation gap, and clearing up some major misconceptions. When people think of an audit, they usually picture financial documents in a magnifying glass, right? They kind of assume auditors are like financial police officers out there trying to catch every single tiny case of fraud. It's an incredibly common misconception. The public, and honestly even some company directors, believe an auditor's job is to uncover all errors, whether they're just innocent mistakes or full-blown intentional deception. But because of the inherent limitations of what an audit actually is, that is simply not the case. We actually call this the expectation gap. See, external auditors do not provide absolute guarantees. There's no rubber stamp saying these accounts are 100% flawless. Instead, the reality is they provide what's called reasonable assurance that the financial statements are free from material misstatement. And material just means it's a big enough deal to actually influence the economic decisions of whoever is using those statements. Closing this gap in understanding is basically step 1 in making sense of the whole audit process. Moving on to Chapter 2, key roles and responsibilities. Basically, who exactly does what? Okay, first up, let's define a slightly clunky but absolutely crucial term you're going to hear a lot in auditing standards: those charged with governance. These are the ultimate overseers of a company's rules and reporting. Depending on the organization, this might be a board of directors, a board of trustees, or even the business owners themselves. Their job is to oversee the financial reporting process, approve the financial statements before they go out to stakeholders, and importantly, they are the ones who appoint and oversee the external auditor. Now, it is absolutely vital to draw a hard line between management, the people who actually build the accounts, and the auditor, who serves only as the independent reviewer. Management is in the driver's seat. They implement the internal controls, they conduct the daily transactions, and they prepare the statements. The auditor, on the flip side, just steps in to get evidence, test management's assertions, and figure out the overall fairness of those statements before issuing an independent report. Everyone has their own specific part to play. And blurring those lines, yeah, that totally compromises the integrity of the whole system. So, at the end of the day, management holds the bag for creating the numbers and designing the systems to protect the company's assets, not the auditor. If fraud happens, it's on management to have had systems in place to prevent and detect it in the first place. Plus, during an audit, management is legally bound to play ball, meaning open, transparent communication and giving auditors unrestricted access to whatever personnel or information they need to gather their audit evidence. All right, into Chapter 3, the role of audit committees. Think of them as the specialized liaison. The audit committee is usually made up of independent directors who aren't bogged down in day-to-day operations. They act as this really critical bridge. They oversee both the external auditors and the company's internal risk management frameworks. They keep an eye on the external auditor's independence and performance, and they evaluate the organization's internal controls safeguarding the assets. Setting up an audit committee is a massive best practice in corporate governance because it adds this objective, impartial layer of oversight to the whole financial reporting process. Next up, Chapter 4, Inside Accounting Systems. Let's look inside their actual habitat. Think of it like a giant funnel. Raw daily transactions are systematically processed through several stages. First, they're recorded: your sales, purchases, payments, all that good stuff. Then they get classified based on accounting standards like IFRS. Next, they're summarized and posted to the general ledger. And finally, all of this data is compiled into financial reporting, the balance sheets and income statements the auditor ultimately reviews. An auditor literally cannot assess risk without a deep understanding of how this financial data actually moves through the pipes.
The big takeaway here is that an auditor has to understand these specific subsystems to figure out exactly where mistakes might be hiding, whether that's tracing a sales invoice from order processing to accounts receivable, checking a purchase order against an accounts payable ledger, or verifying a payroll deduction based on timekeeping data. If the auditor doesn't know these pathways inside and out, they simply can't identify the risks of a material misstatement within them.
Which brings us to our final chapter, Chapter 5, Mastering Internal Controls, the company's immune system. According to international auditing standards like ISA 315, auditors have to evaluate 5 critical components of internal control. It all starts at the very top with the control environment. That's the ethical tone at the top set by management. From there, it moves into assessing risks, setting up specific control activities, making sure those roles are clearly communicated across the company, and finally, ongoing monitoring activities to ensure everything is actually working the way it should over time. Let's look at what these safety nets, the control activities, actually look like in action. You've got authorization, like when a supervisor approves an expense report. You have physical controls, like the electronic tagging of valuable inventory. And then there's a really crucial one, segregation of duties. This just means the person who physically receives the goods in the warehouse is never the same person, like the finance director who authorizes the final payment. Splitting those tasks up heavily reduces the opportunity for any single person to commit and then conceal fraud. And to keep this whole ecosystem healthy, a lot of organizations bring in an internal audit team. Now, unlike external auditors who report to the shareholders, internal auditors are staff within the organization, but they're completely independent from the areas they check. They act as a continuous internal monitor on how well these controls are functioning day to day. Basically, they help management fix the plumbing and avoid problems way before they ever escalate to the level of a material misstatement. As we wrap up this explainer, I want to leave you with a bit of a provocative thought about the safety nets in your own corporate ecosystem. If your organization was externally audited tomorrow, are your internal controls genuinely strong enough? Do you have clear segregation of duties? Does management really understand their ultimate responsibility for the financials? Getting a grip on this external auditing ecosystem doesn't just help the auditors. It empowers the entire organization to build a stronger, more transparent, and infinitely more trustworthy operation. Thanks for hanging out with me today, and keep questioning how the systems around you really work.